Live streaming is on.
All right. Good afternoon, everybody. This is Event Trader, and I am joined naturally by Brett Manning, Chart Trader. And we are going to get into the sentiment and flow show. But I guess the question that I got for Brett, and I know you had posted a comment about shorting in this market earlier today. We had markets slipping down, and obviously I'm just looking at the S&P right now. Dropped down to that 4771 area, which is where we broke out at about 5 a.m. this morning, right? Now that we tested those lows following a 10-year tips auction that we had that saw some really good demand, except the problem with that is, the tips are seeing good demand, that usually takes away from the others. So market participants were kind of mixed on how to address it. Most thought that it wasn't great news for the broader market and the bond market in particular. So we saw holding up levels there at 4771, despite that negative news, and just kind of bouncing around. Then right about 130, that's when I'm guessing all the Congress people got to their phones and started opening up their Robinhood accounts and buying. And then, of course, 39 minutes later, us normies got the news that they had agreed to a deal in the for the budget, and that takes one thing off the table for tomorrow. Kudos to Carmine, who continually calls these out despite all the Politico and CNN and the Hill stories. I mean, like I said, dollars to donuts. I'll take Carmine over any of these clowns that write up and or just seem to be trying to get hits and scare the world or whatever. But so Brett, I know you. I know how you trade, and I know how you kind of look at momentum going into an event, and then a headline-driven
Is this
pop.
still one question that
This
started?
is still one question, yes.
So,
I needed to address it before we got into it. So the question for me, Brett, the short one is: do you want to short this move?
Well, no, I said earlier today I want to short after the mega caps print.
Okay, and that's the answer there. I'm perfectly fine with that.
I mean, I don't even know if I want to short that. I'm just saying, like, if you feel like things are overbought, you feel like people are a little bit too exuberant on the long side. In my experience, in the market that we've had for the last decade or maybe half decade, like where you have such hyper dominance in terms of market cap presence of just a small handful of companies, which I would make the case that that's not wrong or anything. I think they're going to have that share of the economy in the future. But when you have that much, if people are generally bullish on the sentiment side, and you're looking for the market to take a breather, they're not going to sell ahead of those reports. There's just not going to be that kind of offer in there until you get past Apple and Google and Amazon all coming out and saying, here's how awesome things are. And because it's that fear of like, you'll sell and then there'll be the greatest string of earnings reports of all time. And you feel like an idiot. And people just, they're just not going to sell in front of that in an environment like this. So in my experience, you wait until after you get past the mega caps. They're usually pretty well clustered together in earnings season. And if you want to short, you wait till then, and that's when you short. I don't know that I'm going to be doing that, but that's just a general point. I see people kind of constantly typing in our feedback about giving short ideas right now.
Well, I mean, and that brings up an interesting point as well. So when you're looking at the mega cap growth names there, do you feel that has more to do with just their pure weighting on the indice? Because I know obviously when you're doing your shorting, you're usually around indices. Or so is it a weighting issue, or is it just the economic prosperity?
I mean, I think that their growth stories, their narratives are potent in terms of the context, but they also, they've got the 25% share of the market. So you just, whatever it is you've got is going to be helped by those great numbers. Just, if you're indexed at all, especially like on the fund manager side, like if those are all breaking out, you're just going to win because they have such a dominant impact on how the market trades. It's very disproportionate. But disproportionate. I don't know if it's really disproportionate is the right word, but either way, yeah, so much comes down to just a small handful of earnings reports. So if you're looking for the market to take a breather because it's overbought, because people have piled in too much, they've gotten a little bit too exuberant, generally it's going to be just on the other side of that.
Okay. And I haven't checked all the dates on that, but I'm assuming that few will be out next week, followed by the first week of February there. So we'll keep an eye out on that. But let's talk real quick too, Brett, about the first week of earnings. I know you have a pretty good theory on how you like to trade it, or you like to sit out on the sidelines for the most part because there tends to be head fakes going on in the first week. Especially this year, I feel that this year is a little weirder too because feels like we got things kicked off early, and then while financials usually dominate the first week, you also get a few tech names like usually Netflix and IBM are sprinkled in there, and they are all going to be next week, of course. So this has been really
And just to clarify real quick. So Google's January 30th, Amazon, Apple, and Meta are all February 1st. So they're all clustered right around the end of the month.
okay. All right. Well, we'll be definitely keeping an eye out on that. So Brett, but with that first week of trading, is there anything that you have taken from the past couple of sessions there? I know you been following the earnings a little bit on your end, obviously bank heavy, but is there anything in terms of the overall market sentiment that's caught your attention in that
I
first week
mean,
of trade?
obviously, we know that everything's run into this earnings season. So everything's run into the print. So you're getting a lot of, better than expected. Stock doesn't take off, which is exactly what you'd expect. It doesn't really show any weakness. The market was kind of running in front of it. It was discounting this reality. I'm really at this point, I want to see how the flows go. The reason why I usually don't like to trade too much during the first week or two of earnings season is just because there's a different market participant that is dominating the tape. It's very bottom up. It's the low turnover portfolios with a lot of cash, deep pockets, who are invested in a process where really they're going to plan for and react to earnings. They're going to have portfolio turnover that's about once every 3 months, and that's who's dominating the tape right now. And it's a different force that I typically like to estimate in my tape reading. The rest of the time I understand the market better when it's this period of people repositioning in front of or in reaction to the initial earnings as they get a sense of how earnings season is going to go. You've got a different character that's center stage, and it's just, in my experience, I just have less conviction in my ability to predict short-term pattern structure.
Okay. All right. Well, with that, then let's break into the sentiment and flow show. Take a look at some of the dynamics that are impacting us. We would be up 8 points on the short right now, too, Brett. Just as a heads up. So, all right. Market characteristics. So a few of the things that we're looking at here, just getting ready, is obviously we got an election year, so just kind of wanted to see some of the broader characteristics for anybody who didn't get a chance to see our December sentiment and flow show. Definitely recommend taking a look at it. We discussed some of the broader topics that are going to be hot commodities coming into this year and impact markets. But so far right now, the market characteristics as far as 2024 is concerned is we took a brief look at the historical performance in an election year, and the SPX, it's up 86% of the time in years following up and down years. That's up an average of 13%. So obviously we're down in 2022 and then up in 2023. The SPX is up 75% of the time in election years, an average return of about 7.5%. This outpaced the broader market in all the years except for year 3. That tended to be a stronger year. So, one has to wonder too, Brett, the compounding of a third year makes the fourth year returns a little bit tougher too, I suppose you could say. Market does tend to struggle in the first half, and probably a lot of that, and we'll talk about it, Brett, is just figuring out who's going to be running, although it seems like we've got a pretty good idea who's going to be running on both sides at this point. June through August tends to rally. And then you get your normal seasonality in September and October with a lot of the money market fund tax loss selling going on. We talked a lot about that in the last couple of sentiment and flow shows, Brett, right? It was a key reason behind our steadfast belief that we'd have an end of year rally. And then November through December post-election tends to see relief rallies. So that's kind of the ebb and flow of your typical election year. End of year rally that we just had was largely driven by high beta names. Healthcare saw the largest net buying in 5 months in December, so that was a big driver too. A lot of biotech and pharma names as M&A got hot there. Financials, this is last week now. They saw the largest net selling in 16 weeks last week. So just kind of keeping that in mind as we did have a busy week of financials on earnings. Money market funds, they hit a fresh all-time high of 5.98 trillion on January 10. And then one of the key characteristics going on right now is over the past 2 weeks of consolidative movement, most sentiment measures that were in extreme territory, i.e. the AAII, the Lobo ratio, equity hedging, the VIX structure, they've all backed off now and are a little bit more moderately bullish to neutral. So, Brett, let's kind of circle back here. What's your thoughts on that election year? I know, obviously, data mining is always involved with that. So anything that's going on that front, is there anything that jumps out from you on that front?
I mean, I don't see that as a super valuable perspective because, first of all, the market's up not that much shy of 75% of the time, period.
Right.
So it's not that far from just a random year. Which is why most people have a pretty solid long side bias. Overall, though, statistics cold like this, I just think, everything is contextual, and I have a problem really kind of driving my strategic mindset with those sorts of statistics, if that makes sense.
Right. No, I agree. I mean, it's numbers, and at the end of the day, it's great. But that does mean that there's a 25% chance that we could be down this year. So it's not like you could just throw all your money in the market and go to bed, right? What about the ebb and flow? I mean, does that make sense to you from a sentiment standpoint and just psychological standpoint?
What do you mean?
So the idea that we tend to struggle in the first half of election years, and then the June through August tends to be a strong period. Then you get that lull going into the election, and you get the relief rally.
I get what you're saying. I suppose that there's an anxiety that builds up right into the moment of the election, and then you get the relief rally. But just overall, I think there's so many factors at work. I have a tough time doing that kind of analysis or trusting it. Every year is different.
Yeah. So just kind of moving along here. End of year rally. I mean, we were talking a lot about those high beta names. We had been pressing them in November in the sentiment and flow show there. Tended to work out well. So I guess the question for that rally in the high beta names is how would you be approaching, if you're sitting on substantial profits from that run?
Yeah, that's a big question, right? Because to give people a little context, where our take was basically we were really bullish most of last year, particularly in the spring, and then particularly again around late October, just based on sentiment data, just based on the fact that people were positioned in a way that was extremely skewed, and the market was doing well. And one of the things that we got to, that Gavin and I talked about quite a bit, is you have a situation where when you get into early to mid-November, we saw from the BofA stats, the fund manager survey, that this was the first time in 18 months that large fund managers went from underweight to overweight equities, generally speaking. So 18 months of underweight, and then they flipped to overweight. And that's at a point when the NASDAQ's already up 50% for the year. So basically what that tells you is you've got a lot of people, an industry-wide plague of trailing your benchmarks with about 6 to 8 weeks left in the year. And so our thesis was, you're going to see a lot of that money flow go into high beta stocks so that they can make up ground. It's playing catch up. And so, what do you do now when, you've been in regional banks and biotechs and something like the ARC ETF and small caps and REITs and things that have just over this period contextually or just by nature or just higher beta plays. You've been in these things, you may be up 30, 40, 50% in just a couple of months. Is the beginning of the new year just going to be a big cash out on that entire side of the market or not? I think really the question comes down to where you see interest rates going. So I think that and what we see in the Fed funds futures right now and the inflation data outlook, I mean, this is basically, you can keep that narrative going if we're shifting back to a period that's really more like 2020 and 2021 and before, where you basically have a situation where you don't have these rate sensitive stocks just getting hammered by the inflation problem and the Fed hiking rates. And instead, we've got this disinflationary trend, and we get it to a situation where growth is still okay, but the Fed is still set to cut. And I think under those conditions, I think these trends can extend. So I think it really comes down to where you see that inflation and interest rate narrative in 2024.
All right, Brett, just give me a quick second here. I'm just working on, I believe some people are having an issue seeing the slideshow. So, okay. Yeah, so with working with this here then right now, any thoughts on healthcare or financials in particular? I know you usually don't break down the market segments, but biotech's certainly been a hot area.
Well, so in both cases, you go right back to what I was just talking about. I mean, if you think that we're actually going to see the Fed largely normalize rates based on where the inflation trend is, and we see these cuts really start to come through. The Fed funds futures is showing 5 to 6 cuts this year. If that actually happens, then yeah, I mean, biotechs power the healthcare growth side. Biotechs are largely long duration. They're going to suffer under a rising interest rate environment. They're going to, rip during a situation where the Fed is cutting rates while there's still growth. Financials, you look at the regional bank situation, same thing really when you're talking about rates at the long end coming down. Takes a lot of that pressure off that we saw basically crash the sector. So in both cases and in the previous question too, it really comes down to where you think the interest rates are going to head this year. I think if this is a false bounce in bonds, if it's a false dip in rates, then all this stuff turns around hard.
Okay. Money market funds, you see that as a nice potential source of liquidity for stocks as they hit all-time highs of 5.98 trillion.
Yeah, it's kind of remarkable, huh? Yeah.
Yeah. Do you think that just highlights that people are quite happy with the yield that's still getting paid over there? Or do you think it's more of, I don't want to chase this market, I'm just going to sit in here and wait for this market to come back to me?
I think it's both exactly. I think that if you're in a situation where you profited from the big run that's just happened and you're a little bit uncertain about the future, it's more tempting to move into that kind of situation with interest rates as high as they are. Normally, you probably wouldn't see as much migration.
All right. The last piece, obviously a key one with the sentiment data now, Brett, we're going to be going through this. So rather than just kind of throwing this question at you and letting the cat out of the bag for the conversation, how about we pop in and take a look at that AAII data, take a look through some of the slides that are going on in there. And obviously we saw bulls really pull back here about 820 basis points from 48.6 to 40.4%. A lot of that camp went into the neutral, which popped up 570 basis points. But bulls hitting 26.8%. That would have been the highest since December 6th when we got up to 27.4. The bulls, that was the lowest since November 1, which was obviously when we kicked off that rally to end the year. Just kind of taking a look through, we could see bullish sentiment still above historical average, but hardly at extremes. And then, of course, looking at the 8-week moving average for bulls, it's possible we did see a peak back on January 11th when it hit 48.63%. Of course, when you're looking at an 8-week moving average, that means that we dropped off some of those difficult numbers at the beginning of November. And that led to a pop from 39 to 48 pretty quickly, but it dropped from 48.63 to 48.02. So obviously, Brett, things still looking upbeat on the sentiment front, but definitely has pulled back from the peaks, yet we're still holding ground pretty nicely. How do you take a look at some of the sentiment data that we're getting and take a look at the price action that we're seeing and kind of match them together to get a feel for where you see the market?
So on the bull side, I think AAII is usually not a very good contrarian indicator. There's a lot of historical examples where you see periods where it gets to seemingly extreme levels, really kind of in the middle of a bull market trend, and it just kind of sticks there and bounces around, just like what we've just seen. You maybe get a 50% bullish number, then you pull back to 40% in a little bit of a choppy period, then you're right back at 50%. It just kind of sticks around, and the market keeps going. But it's really when you see that kind of accompanied by other factors, like just extreme options skews, an extreme lack of hedging, really, really low cash levels in the BofA stuff. Like when you see it all kind of come together, you can get a situation where, you see everybody leaning at once. But AAII by itself, I think, is a better indicator in a bearish trend where people fester in a too bearish place, basically like we saw in October. And it was one of our key signals to get really bullish for the end of the year. But that
Does that go back to the theory that the market's up 75% of the time?
I suppose so. It could just these, yeah. So there's an asymmetry fundamentally to positioning in the market, and if people are relatively positioned more on the long side than the short side, that's the normal level, like that's the midpoint. So when you see some of these numbers, really it's if people are overly bullish, that's kind of typical of bull market trends that can continue. And when people are overly bearish and the market still has a tough time breaking, that's a danger sign if you're short.
All right. So, what are some things that would kind of pique your interest moving forward? Just using the AAII data as a example, like if we saw a big drop off in bullish sentiment and markets held steady, or another pop up higher in bullish sentiment, and we just kind of started launching to extremes. Is there anything that you're kind of looking for as a pattern on what could get you into some to act?
Yeah, I mean, I see mismatches as generally important. Like if the pattern looks like it's not doing so well, and people get exceedingly bullish on some kind of news narrative, that's usually something where I'll kind of think a little bit more about, like, this is a short opportunity, especially again if it's accompanied by other things. There's no hedging in the market. There's too many calls being bought relative to puts. There's too much cash, or there's too little cash, in the hands of portfolio managers. If that's all lining up at the same time, and the market's not acting that great, and there's a really bullish, positive narrative that's in the headlines all at the same time, and I can see just the sense that the market is not really acting as well as it should under those conditions, but everybody is just loaded for bull. That's something that I would really take note of. Otherwise, yeah, if you have this one big down day, the other side of that is get one big flash down day in a bullish trend. Generally speaking, the rhythm is there are small days on the upside, big days on the downside. That's just a classic symptom of being in a bull market. Is you grinding to the upside, an occasional elevator shaft for a day or two, and then you're back to grinding to the upside. Usually the biggest moves are in the direction that's opposite to the trend that's sustainable. So when you get a big rally in a bear market, usually something to fade when it's really fast and sharp and powerful. Same token, you get a grinding bunch of small upward days and then a big down day. If everybody gets really bearish off of that right away, it's just, this is what a dip to buy looks like. Something scary that shakes people out, that makes people nervous, that gets people hedged. But really it's just kind of a 1 or 2 day trapdoor event. So those sorts of events usually are really classic buy signals on the bull side.
Let me ask you while we're talking about sentiment data, have you had any thoughts on the Empire or Philly Fed numbers that we saw this week? I mean, the Empire in particular was pretty abysmal. I know we've talked about the bubble of bearish sentiment
Yeah,
over
right.
the last 18 months or whatever. Um, did that number surprise you at all or anything?
I mean, it seems like the market just overlooked it so easily that but yeah, I guess it's interesting that and the Philly both just kind of interesting how it just doesn't seem to match up with anything else that we're
Right.
seeing.
Like, I mean, you look at the retail sales number that came out a day after the Empire, and you
Yeah,
just like, what are we missing here, right?
right.
And then you look at the beige book, which was noting that New York was bustling with tourism
Yeah,
and everything, and then you just kind of look at the New York Empire. It doesn't match up like you say.
right. It's just like people are just they have such a difficult time believing that we're living in a world that's working well.
Yeah, yeah. So, well, there's also the argument that it's working well for half the people, right? So, we'll,
Right,
we'll,
but the
we'll
purchasing managers for big companies would be the people it's probably working well for.
yeah, yeah. You would think so. So, we'll continue to match that up, but it'll set an interesting tone for earnings season as we get more and more. But you had Fastenal out this morning; they had pretty decent results, and so I don't, that's a little bit of a harbinger for how industrials are doing. So, but yeah, it's going to be something that we're watching closely. But again, that sentiment data coming from the corporates seems to continue to be dour. It's like they're sandbagging everything just to make sure that they beat their numbers, I guess, Brett.
Yeah.
All right, moving on from the AAII data. Bank of America Fund Manager Survey, a few items of interest. Optimistic on rate cuts and soft landing, and we're going to get into all of these. Cash levels were up from 4.5% to 4.8%. So some people's squirreling away some money for perhaps pullback, some profit taking, what and looking for other things to buy. Least pessimistic on global growth since February 2023. We saw a rotation from bonds into cash, as we just noted above, and banks into REITs. So people looking to get back into the beaten down REIT category, of course, with expectations for rate cuts. Um,
Yeah.
that's definitely helping provide a boost there. And then the largest overweight in U.S. stocks since December of 2021, but that doesn't match up with all the data that we're seeing. So,
No, it doesn't.
Brett, before we break deeper into this on a broad perspective, how do you see these numbers and or these key points? And is there anything jumping off the page to you?
I mean, I think that again, that they've been underweight U.S. stocks since April 2022. So it's not that hard of a bar to get to
Right,
back to
right.
December 2021. It's like you've been underweight the whole time since then. So you're barely peeking above the surface and you pop back to there. Cash levels, kind of consistent with some of the pullbacks we've seen in other sentiment indicators. Just so we went from 5.4% down to 4.5%, now bump back to 4.8%. Just a little bit more sort of, the market's been up a bunch. And we've got the new year, we've got a new theme. And so just kind of maybe getting a little bit more protected. We've seen hedging bump up a little bit. So, people are a little bit cautious, which is exactly what a consolidation is supposed to do.
All right. So, and we're going to show a chart in a little bit here talking about that consolidation. Here's the overweight equities, Brett. As we could see, there's still plenty of room to run on this front here.
Yeah, just
I mean,
understand, people, it's the light blue histogram that's important here.
right. So the dark blue up there, that's just your typical global equities basket for a 60-30-10. The light blue is percentage overweight in equities. And you can see 20 through 22, the euphoria that was going on there, obviously. A bit of a dump going on into 2022, but we're slowly peaking back up. But boy, when you're talking about waiting, Brett, there's still plenty of room for upside on this
Yeah,
particular
exactly.
fund.
So it's not like we've reached an extreme.
Yeah, so kind of keep that in mind as we're walking through valuations. This is just grabbing Goldman's where we kind of stand right now. Obviously, keeping an eye out on the EPS consensus. Now, Goldman is a little bit more conservative than the rest of the market here. They're projecting 5% EPS growth. This is for the entire S&P. The consensus currently right now is closer to 243, which would be a 10% increase. And then you can see Goldman remains a little bit more a little bit more conservative on their 2025 outlook. But taking a look at the PE ratio, it does make a little bit of a difference in terms of whether or not we're viewed as expensive or not. Now, there's definitely the argument, Brett, that valuations have crept up with inflation there. So 20 is the new 18, right? And
Yeah, well,
that factors in here. But any thoughts on this particular valuation slide and how it could factor into your investment theory?
so last year, pretty much all the gains in the market were accounted for by multiple expansion rather than earnings performance. But here's the interesting thing. Historically, if you go back, that sort of year when you see the market take off, where really it's just multiple expansions, just companies being valued higher than they were, people were maybe undervaluing them relative to whatever worldly, like this is all based on the context of actual growth potential and productivity potential in the world. So, you have historically years like that are usually followed by extensions of those gains. In other words, the market's function is to look around the corner and assess the future opportunity for companies to grow. And usually, when you have periods, when you have years that are really good and they're basically good because of multiple expansion rather than earnings performance, it's usually the market being right about looking around the corner. Typically, that's been the case. It's a statistical fact. So what we saw last year was basically that kind of year. The market is saying people were too pessimistic about the future growth potential, and so that needs to be priced in. And it's a forward pricing discounting mechanism about future growth, and we're going to see the earnings happen after the fact, but shares are pricing it in ahead of time. And that's typically the way the market works. And I think that's the theory that we're working on right now. Maybe it'll be wrong this time, but that's still, I think, what the market is doing.
All right. And the market right now, Brett, squeezing up to session highs here at 48.07 at the moment. So we'll continue to keep an eye out on that. So moving along, here's a good chart on the breadth of the rally that we had just watched. This is from Bank of America. The top chart there, as you can see, that's the S&P movers, and then the bottom one is the advanced decline line. These are all on daily charts. So the AD line probed to new highs during the part of that run. Now, you were talking a lot, Brett, about the small caps and the high beta names getting involved and not just doing all the heavy lifting. I think that was pretty evident on this particular slide. Now, I guess the question would be, how would you like to see this slide continue? I mean, obviously, if you're bullish, you want to continue to go up, but what do you think it does look a little extended right now? Obviously, got a little bit of a breakout, but what would you be looking at if you were watching the advanced decline line for trying to infer what the market's going to do?
Well, so again, I think that whole narrative is going to come down to interest rate outlook. But that said, we've seen a little bit of warning signs here in terms of the McClellan oscillator over the last maybe week or so, where it started to dive back down.
And just a recap for people on the McClellan oscillator.
So it just shows. I mean, it's one of the best breadth indicators. It's an oscillator based on looking at how all the individual stocks compare to the index. So we've seen particularly small caps and then energies have really kind of underperformed. Transports have started to underperform again, and these are the areas that we saw really pick up and take off. But you look at something like NIMO, and it's back down to the New York Stock Exchange version of the McClellan oscillator. It's back down to where it was in early November or late October, just in the last week or so, showing kind of like it. And it's really something that started, I guess, maybe about a week before the end of the year. Just kind of this breadth explosion that we saw and all the breadth thrusts that we talked about, something like the Zweig breadth thrust. We listed like 7 or 8 of them last time. where you really see this remarkable period of everything suddenly bursting higher together at once. And that there's a lot of historical data showing that that has a big payoff in terms of follow through for the market. So we saw that period during the last 2 months of the year. And really, we've started to see that taper off so far in 2024. And it's possible that we have a little bit of a, we're back to basically being it's the Magnificent Seven powering the market higher, really, right? I mean, over the last week and a half, if you look at where the Russell 2000 is relative to the NASDAQ 100, it's kind of back in that narrative a bit. And to me, again, this is this sort of the hangover from this beta chase. And the fact that, interest rates have kind of moved back up 3.8% to 4.1, 4.2, we're kind of, in that zone again where it's not quite the same narrative. And, I suppose I'm looking for that to be a trend that's going to continue. So in other words, we see, the 10-year moves from 3.7, 3.8 up to 4.1, 4.2, and then it moves back under 4 and moves lower as the Fed starts to roll out these cuts. And we see this kind of normalization of inflation. And I think that everything in terms of this breadth picture and in terms of a lot of these sort of more rate sensitive sides of the market is really going to depend upon that narrative. And if we move back into a situation where, the 10 years above 4.5%, it's really going to crack things in terms of the breadth picture.
All right. So watching here, here's another chart on that large versus small cap, Brett. And, for the first time since June 2021, large caps expected to underperform small caps. And again, we're kind of probably beating a dead horse. This just goes back to the interest rate discussion, right? So, but interesting to see that pass through. The last time we saw that would have been in early 2021. All right, moving along here. Wanted your thoughts on this chart, Brett. Now, I was going through a Bank of America note. Company handles, I know you're well versed in them. I know that's not your usual go-to in terms of what you're following and everything, but we just have here the SPX chart that was showing a cup and handle very similar with this type of chart now. Which is also where I got a lot of the presidential election years, and just kind of taking a quick look at that, Brett. Some of the other areas that we're seeing a similar cup and handle chart. It was a pretty big basket.
It's also the best kind.
Yeah,
it's the best kind because that the handle has a sentiment bearish extreme at its base that's even greater than the cup. And that's the best kind to me. So this is one of the reasons why I'm bullish, generally speaking.
The idea of a big basing cycle, right?
It's the higher low is where you see even more powerful bearishness in the sentiment data and the positioning data and the hedging data. And that's in the big picture. I mean, who knows what's going to happen in any given instance, but that's a really compelling factor in the market right now to me. In the big 30,000 foot view, if you made this a monthly chart instead of a daily chart, and you just look at the rhythm of these things, and you've got this, the cup side of it, the bear market of 2022 and the way that it formed a bottom and the narrative around that, and then you move back up. And then you pull back a little bit and people get even more bearish and more malpositioned. And then you move back up to retest that high. Like in the biggest picture, it's just so hard for me to see this thing not breaking out.
Yeah. And we just have the SPX chart up here, Brett. NDX, NASDAQ, also similar. The S&P 100, the Dow Jones Industrial Average was also on the list there. The S&P 1000, the Russell 2000 also had a similar cup and handle chart going along here.
And just let me add to it. When you see the base of the handle, that's when you had that what we talked about for 2 months, that 1.2 10-day moving average of the put call ratio, which is really rare and really powerful. It's a great track record. You had a 4-year high in hedge fund short interest at the same time. You had cash levels of big portfolio managers at the 5.4, 5.5%, which is rare and big and important. And you had just this overall deep sense of just pessimism kind of accompanying that point. And then what we got out of it was all these breadth thrusts, all these statistically well-researched ideas where, you've got, like, for instance, the Zweig breadth thrust for the NYSE, where it's happened like, I had the stats last time, but it, some number of times back to 1945, and it's never ever resulted in anything but an extended upward trend. And we had like 6 or 7 of those sorts of data points. So, like, you get this really bearish situation, you get this enormous shift and pivot in terms of the way people are treating the market, and you get right back and test that high. Like, I mean, every instance is different. Like we talked about earlier, every year is different. It's tough to trust data mining, but there's a big track record for a lot of different things here that all kind of overlap and intersect in this situation right now, and all of them have basically a perfect track record over history. So it's really tough to believe that this time around everybody has saturated their interest in the market already and is in this exuberant situation where they can't possibly buy more equities. And it's really tough to believe the transition could happen in 2 months rather than to break out through this high. And then again, look, if we attach this to the other narrative that we've talked about a lot over the last year, which is what's the corollary for right now? Corollary for right now to me is, mid 1990s. I don't see how there's not the corollary there. You've got the soft landing narrative, and then you've got the technological revolution narrative at the same time. So, like, it's tough to not kind of line all these pieces together and see the public starting to get a lot more excited. Now, we've got some differences there. The main difference relative to the 1990s is that at that time, we'd recently seen the fall of the Berlin Wall. We were opening up trading routes, and we had a sort of geopolitical detensioning kind of situation. But otherwise, especially now that we bumped interest rates up and they can drip back down, you've got a lot of corollaries there on the technology side, on the even on the demographic side, with the millennials kind of taking the role of the boomers at that point, just coming into their prime,
producing buying power.
With their prime, producing and consuming and disposable income and investing period of their lives. And it's the biggest generation of all time. And in the 1990s, that was the boomers, and they were basically in the same point in their lives. So, like, there's all of these kind of corollaries that line up there, and then you get a pattern like this, and people just malpositioned on the short side and overhedged and in too much cash, and a series of technology revolutions starting to roll out. I mean, I have a hard time not seeing that, when I kind of take a big picture, 30,000-foot view of the market.
Yeah, and it's not just the U.S. indices either. Euro Stocks 50 seen a very similar move. The DAX as well, the dollar index, the FTSE is caught up into that. So it was pretty interesting. Nikkei 225 as well, the topics. So there's a lot of charts that are having this this cup and handle shaping going on right now. So definitely going to be something to keep an eye out on, especially for the big cup and handle traders out there. All right, Brett, moving on. Election year returns. Here's the breakdown for you. So again, 75% in year 4, fell short of 79%. All years, 66.67%. So it is above that, certainly year 1 and 2. So, we'll continue to move on from this. As we said, not every cycle is going to be the same, but just if you're looking for a general rate of return on election years, here's an interesting chart. This is from the Bank of America Fund Manager Survey, Brett. The question was, what is going to be the primary driver of the market? And we've been talking a lot about it, and that's Fed rate cuts, of course, running in at 52%, or half the people that respond, or 52 of the people that responded, nearly half thought that would be the Fed is the key driver. Corporate earnings, number 2. So we're starting to get the answers on corporate earnings, liquidity, Coming in at number 7, AI 3, China 2, another 1. So any thoughts on this, or is it just kind of reinforcing what we've been talking about there? And that is the idea that a lot of where the money flows will depend on what the Fed does with rates.
Yeah. So, well, first of all, just to sew up a previous point, the S&P 500 since its inception in 1926 has been positive 73% of all years.
Okay.
So saying that it's 75% of all presidential, I mean, it's a meaningless data point for people who are curious about, I mean, you might as well just say every year is about that. So
Right.
it's not, there's no standout. Otherwise, I think that, it's the Fed, right? I mean, it's like, which says it's all this whole narrative that we've been talking about, which says like for this year, for right now, if we can have strong, persistent growth and the Fed cutting 6 times, how are you going to not buy the market? Like, there's no universe in which you're going to have negative cash flows into equities when you have strong economic growth and the Fed cutting 5 times in a year. There's no universe in which that's ever going to happen. I don't know if that's ever happened. I mean, can you imagine such a situation? What could be more bullish than that? Like the Fed constantly doing rate cut after rate cut after rate cut. And you're sitting there with, hey, we've got good jobs growth. We've got good productivity growth. We've got good GDP growth. The whole thing is happening at the same time. So it's really kind of like, is it right? Is it right that the narrative right now is really that we have this weird outlier period, which really at the, for the very 30,000 foot view actually was transitory inflation based on reopening of the world following a pandemic that lasted a couple of years. And that really it actually was supply chain disruptions and just a lot of sort of, wrenches in the gears of everything. And that we're finally normalizing out of that. And all that inflation is coming back down because everything's just the on-demand economy of the world is working smoother. And that's pressing back against any inflationary pressures to such an extent that the Fed is outlandish to have 5.25% interest rates. And they know it. And even if we continue to have strong growth, and by the way, strengthening productivity growth for a period here of the last several quarters, and tools that are coming up technologically to even augment that further, are we in a position where we're just going to have strong growth and the Fed cutting rates? Because if that's real, then obviously that's the narrative that's going to shape the market. And I guess corporate earnings get subsumed into that, but it's this question, I think, of is that real? Is that a real thing? Or are we going to suddenly see the PCE go back to 4.5% and, the Fed start to hike again or something? Is that all a mirage or is that real? I think that's the question of 2024.
All right. And we'll be obviously watching that pretty closely there. So moving along, rate expectations, Brett. Expectations for lower short-term rates at a record high. There's got to be some counter cyclical or counterparty risk concerns there, I suppose. I'm sorry, the idea that there have already been, the rate hikes are done. That's just going to start pulling down.
What I was just talking
about. Yeah, and the counterparty risks aren't there as much. But then there seems to be a little bit of an inflection point in longer term rate expectations, right? Where December seems to have hit a bit of a peak.
Yeah. Well, I mean, the question is how steep's the curve going to be?
Right.
Right. I mean, what world are we living in?
And well, if you look at the money flowing out of the financials, there's got to be some concerns that it's going to continue to just kind of be flat, right?
Right. Well, I mean, we'll see. If you end up with a world where we've been inverse this whole time, 2 to 10.
Yeah.
We climb out of that. If we have a soft landing and we don't have an inverse yield curve, financials all the way, right?
Yeah, I mean that would be the move, but it's funny that we're not seeing anybody piling into them at all. Maybe that's the move, right? So we'll keep an eye out on the financials there. CPI
we keep growth up and we lower rates, lending rates. We're looking at lower the default rate then. So
yeah, Yeah. So then CPI expectations here, Brett. Those that think that CPI is going to be higher on a year-over-year basis, you can see that's fallen off dramatically, but a little bit of an uptick going on over the last couple of months here. You think that's just simply from the fact that expectations for a low CPI are just kind of hit bottoming out a bit. It's pretty much the inverse of what we're seeing on the yields.
I mean, yeah. I guess so. This is it's interesting. So it was diving the entire time inflation was going up.
Yeah.
All right.
Which,
I don't know what to do with this data point.
Yeah. Okay. No, that's fair enough. I was jumping out to me too, which is why I was kind of curious to hear your thoughts on it. I mean, you could see what was going on back around 2007 as well. So,
Well, sure. I mean, obviously, you got a deflationary recession. You're not going to see CPI going up. I guess just it's weird.
Well, I guess if you're looking at it from the prospect of that, inflation was so high that they figured that it had no place to go but down.
I mean, I think the time for, I mean, it's the pandemic. Like, look at where,
Right.
You're starting to build up into 2020 March,
Yeah.
and people are like, hey, inflation's picking up. The Fed's going to have to hike. And then the pandemic hits. And people are just so convinced for 2 years that it's going to lead to just, devastating deflation. And it's weird that they reacted so little to the inflation that we saw.
Yeah. Well, I guess it wasn't until it was upon us, and then the sentiment just kind of changes, right?
Yeah.
Would be how
I kept thinking the top is in inflation over and over and over again, I guess.
Yeah, that's kind of how I see it playing out. So, but definitely, again, yields, inflation, just watching all that play out. And here we go with the food
And
energy.
yet they were bearish and short bonds the whole time.
Yeah,
So,
they're actually
really
the
odd.
action's never,
Really
the
odd
action's
data
never laid out, right?
Yeah.
And here we go with the sticky price consumer numbers.
Super
We can
core.
see the super core, and we can continue to see that slipping down here,
Yeah.
lowest level since September of 21. And that continues to melt away. The Fed's got to be happy with this. The CPI data, obviously, saw that uptick, a lot of it to the owner equivalent rent and shelter index, Brett. But a lot of concerns about that just being a delayed a delayed indicator. So it's going to be interesting to see if all of a sudden inflation falls off a cliff here in a little bit.
Well, yeah, I think the most important data point that I've seen is the PCE headline 6-month annualized on the last time out. So over the last 6 months, if you annualize that, 1.9%, and that's what the Fed's looking at. That's their most favored instrument. So that's below target inflation for the last 6 months.
Which doesn't match up with their hawkish rhetoric, right?
Well,
I think they're just trying to get the market off of the idea that there's 6 rate cuts coming in.
Well, they don't want to get the market to price it in before they do it.
Yeah.
You know what I mean? They just don't. They want to do it, but they don't want the market to price it in ahead of time because then they can't do it. So I think it's just
if they wanted to do that, you don't think that would be laid out? See, I don't think that they want to cut it 6 times, because I think if they're cutting it 6 times, that means it's because the economy is really bottoming out. And I don't think that they want to cut 6 times in an election year either.
Well, let me ask you. Yeah, I'll get that point, but let's just take that out of it for a second. Let me ask you this: if that continues to be the case, that their main inflation measure shows 1.9% inflation, don't you think that they want to get down to 3.5%?
Yeah, I mean that's their projections, right? And
That's
obviously,
but that'd be.
but I think that they think it could get down to 1.9% by cutting down to 4 to 4.25 is what I kind of.
No, it's already there. It's already
What?
1.9% on a 6-month annualized basis. It's already there.
Oh, it's already there.
It's already there. PCE 6-month annualized basis is 1.9% right now.
That's the core, or
No,
the headline?
that's the PCE headline.
So I mean, I guess maybe they just view that as transitory energy prices, perhaps.
I don't know, but I'm just saying that's where it is. Like
Because I mean, obviously, energy's got to be a pretty big drag on that. Looking at nat gas and oil prices.
yeah, but I don't think it's as big as it is with CPI, which is why they like the PCE.
Yeah,
So
yeah, that makes sense.
right, but I mean, just generally speaking, like if the language that I hear from Powell is, it to me is just such an overwhelming rejuvenation of team transitory over the last 3 times he's talked. He's almost saying nanny nanny boo boo. I was right. Like that this was all just a mirage based on reopening after the pandemic. And if that's what he thinks, and if that's what they think, and if there's any data that's going to suggest that that's correct over the next few months, then it's absurd to be anywhere near 5%. Like it doesn't matter what else is true about the economy. It's absurd to be anywhere near 5% if that's reality. Because that suggests inflation is coming down not because of restrictive Fed policy, but because of the sort of normalization of the gears of the global economy, which means they don't need to be sitting up there. Like they needed to react that way because there was concerns in the public about the way the Fed was handling things. But as it starts to drip down, all you need is that next big downtick in any of these numbers, and they're justified in saying we've been living in a mirage. And it's time to renormalize everything. And I think that's why the Fed funds futures show, 3.75% by the end of the year. I think that's what's in there now. And I think that's why is because the market is basically saying, there's a pretty good chance that that's the case. And the Fed it's not going to be about the tight jobs market. That's really going to be inconsequential. If they start to see all of their measures normalize to maybe even under target inflation, through mid-year and into the fall, like they're going to be correcting course drastically. And that's already in the Fed funds futures. So I think all of that, again, so going back to what I said just a few minutes ago, if that narrative is wrong, there's a lot of consequences with the way the market is starting to populate its positions. But I feel like that's where people are starting to place their bets, is that this has all been a weird acid trip of an inflation period for a couple of years, and that really not that much has changed on a structural level, and that this has to do with more logistical considerations about reopening after a global pandemic. And if that's the case, the Fed is going to, adjust significantly, regardless of where the growth data is. And that shows up in the data so far. So we'll see. That seems to be Powell's rhetoric to me. He doesn't want to let the market get ahead of him by pricing all of that in before he does it, because that makes it much more difficult if financial conditions ease that much ahead of the Fed making any moves. So their communications channel is pretty much assigned the job of preventing that until they start to make their adjustment. But we'll see.
Yeah, obviously something I'll be watch closely over the course of the year. Tail risks, geopolitics has popped back up to number 1 here. Economic hard landing. It's funny that the economic hard landing comes in second when you look at the soft landing being the base case for a lot of the respondents there. Higher inflation. I know you always hate this one because it doesn't really give a weighting to it, but U.S. elections starting to creep up. A lot of this probably came out before the Iowa caucus. Are you expecting to see that one creep up a little bit higher there?
I guess I just would love it if they had found a way to do this data point with a conviction coefficient. Like people who felt really strongly about their answers, let's see what those answers are and how much of a percentage of the total sample felt really strongly about it. Because this is a multiple choice question, and if you've got a bunch of people going, I can't differentiate between any of these points, I'll just choose some answers.
Right,
there's a lot of times I think where that really makes it like you're flipping between two very different ideas, and you take it as some significant data point, and really, that's the result of somebody who really has no differentiating edge in terms of their conviction about their answer. But yeah, I suppose it's my theory that at this point the political situation in the United States is an underappreciated tail risk.
Yeah, interesting to see the AI bubble kind of sneak back up in there too. So,
which has a risk, right? I mean, that's kind of
Yeah, but I guess
But
they're looking at it as kind of like the internet bubble of the late 90s, early 2000s, right?
we haven't
So
seen anything.
nothing like that. There's been no valuations even on par with some of the internet
But
names that
I
we've
guess you
seen.
could make a case that people are saying it's built in underneath the surface to everything because AI is going to change everything for every industry.
Yeah.
So it's like that. There's going to be this massive increased productivity to everything just based on this resource, and so everybody's gonna like there may be something built into the market that way. And I suppose if you're skeptical and you say, not really, that's not actually going to come to fruition, and people are too excited about this technology.
Yeah, I heard a great line on AI today at Davos. I forget who said it, but I was along the lines of AI is not going to replace jobs. People who know how to use AI are going to replace the people in those jobs. And I thought that was a very pertinent
But
point
AI
on
will replace those people.
AI won't replace those people. People that can use
No,
AI
no,
will
no.
be able to
You're not
replace
getting
those
my
people.
joke. AI will replace the people who know how to use AI well. AI will know how to use AI well better.
Okay, I got you. Yeah, fair enough. Fair enough. That could certainly happen.
We'll see.
So, China inflection point, Brett. Just wanted to take a quick look at this. Obviously, China has been a bit of a dumpster fire over the last couple of months, certainly in the economic data and the stock market performance. Um, for the first time in 21 months, investors expect a weaker Chinese economy. So, the whole China is going to be one of the main drivers for us in 2023. That's obviously thrown out the door. People were 100% wrong on that. Are they going to be 100% wrong on the way back up
Right.
now?
That's really interesting. I mean, I guess that you think this is because they've tried stimulus twice in the last 3 months and it's done nothing.
Yeah, I mean, it's weird. It's like they've been doing stimulus light the entire time, right? They keep thinking that they could
But
poke little holes here and there,
they
and
do
they
this big
don't seem to be
rollout
able
every
to
once in a
achieve it.
while, right? They do this big rollout with a PR campaign about now we're really hitting the gas pedal, and then it's sort of like you look back a month later and it's done nothing.
Yeah, yeah. I mean, it's definitely got to be frustrating for folks over there, I would think.
But
So,
then,
but
this goes back to, I mean, honestly, this goes back to 2 or 3 years ago when we got a course correction, where the whole Beijing basically shifted and said we don't care about near term economic growth, and they made it very clear. And they said we're going to prioritize cultural issues over all of that. You remember this?
yeah,
Yeah, I mean, it was very clear. Like we don't care anymore. Like we don't believe that the situation is tenuous for us if we don't have strong economic growth over the next year. We'll pay lip service to that, and we'll try to keep that together. But the main thing is we got to 5 to 10 year cultural picture, and we're gonna clamp. We're gonna really, attack these trends in culture that we don't want to continue to persist, and that's where most of our investment and interest is going to go. And at that point, I think you could have just said, I'm getting everything out of China from an investment standpoint.
yeah. And, it's going to be interesting to see. Obviously, China had a big delegation at Davos, a lot of talk about China around there, but doesn't seem to be a lot of people willing to move off the sidelines and do business there. So it's going to be something we'll be watching. But I was interested to see this dropping down into negative territory, considering how
Yeah,
wrong
right,
this
right.
chart was in 2023.
It's remarkable.
Just real quick, a couple recap slides here. Non-financial corporate burdens. This is something Brett and I were pointing out in the last one. This is the same slide, mind you. So I do need to get an update, but just a reminder when people are concerned about the corporate interest burden, while it's certainly growing for the U.S. as a percentage of their budget, right now for corporates still remains pretty low. A lot of the refinancing that was going on helped out there, expecting a big rush of issuance at the early part of 2024 too, as we see rates cool off a little. The rate cut cycle, just as a reminder here, we went through these slides in the last one. Recessions on average have begun 12 months after the peak in the funds rate, which of course would have occurred last time they hiked was in June of last year, right, Brett? Or no,
Uh,
when was it?
Man, you're killing me.
Yeah, June of last year.
Yeah,
So
yeah, right.
which lines us up with around May 24th or May of 2024. So just something to kind of keep an eye out on there. Again, we're not holding it the foot to the fire, expecting that as things can change on a historical basis, and then easing in monetary policy typically begins before a recession starts. Of course, we've seen a lot of kickback against that March rate cut. We'll see how that pans out. A lot of talks about it. First one coming in Q3, which seems to be the base case for the Fed. Whether or not that stands pat, as Brett was saying, remains to be seen. So, there are just a couple of replay slides that we wanted to add in. But so, Brett, with all this in tow now, we're at the end of the show here, at the end of the slides. Certainly, the pullback at the beginning of 2024 has eased things off a little bit. We don't seem to be overextended. We were talking about looking for a nice, calm, cool correction for people to reload and enter in and buy. And it certainly seems at the early part, at least how the charts are playing out, we're trending in that direction. Now, there's still a lot to come on the earnings front. We're going to continue to be watching economic data too as that falls out and see how that impacts rates, which obviously people are keeping a close eye on, as evident by that one slide. But overall, the way I see it, Brett, a little bit of consolidation, and the bullish trend certainly remains in play, with some question marks out there on the geopolitical front, of course, the earnings and the economics. So how would you encapsulate our discussion today, and what is your outlook for the markets in the coming weeks?
So I think that there's this big time frame issue that's like sort of front and center. And I think it has a really interesting way that it plays into sort of the game theory landscape of how people are making decisions with their money. And the time frame idea is like people are, and we've talked about this before. This is going to be a rerun of a rant for a second. But we've seen people kind of get into a situation where they can get really bearish really quick. And Gavin, can you mute that for a second? Can you mute
Sorry,
yourself?
yeah,
I got a lot of clicking, awesome clicking noises. But all right, so people can get into a really bearish mindset really quick on a shorter time frame perspective, where there's a lot of things that can go wrong over the course of, let's say, a 3 to 6 or 9 month period. But at the same time, we're sitting in this larger time frame picture where there's a lot of really revolutionary changes, revolutionary technologies that are kind of rolling out and sort of starting to show themselves, that it can have a huge impact. There's some risks to that big picture. So you can take the picture that this is somewhere in the 1990s or somewhere in the 1920s, where you have a lot of revolutionary changes that are rolling out, and you've got a big demographic and a lot of disposable investment capital that can kind of reshape the markets. But you could also take the perspective this time, and I think that this is going to become the biggest narrative. And this is a departure from anything we've talked about, but I'm still really kind of caught on it, which is I think that what's going to become one of the important on the fence narratives is really the degree to which we can end up maintaining the type of structure that we have in a very broad sense with AI technology, and a lot of the sort of reshaping that's probably coming over the next 5 years in terms of the way the economy works. Like how much are you forced into a position where you have to socialize more, where you have to say, like, we can't let this just be profits for individual companies who are replacing legions of workers with technology products. And what does that do to the value of shares? And I think that that's almost like the most important consideration. The overall productivity of the situation, the overall growth potential doesn't really change there. It's like, how do you capitalize on that? And is shares going to end up being the way? Or is there this big regulatory intervention? Because eventually, I mean, let's take it to its logical extreme. Eventually, if let's say a company, Megasoft, was able to just basically fire everybody and have all-time record profits, they're going to have nobody to sell to in the most extreme version, because you end up with a society of people who are all out of work. Like, where does that's an extreme example. I know it's an exaggeration, but somewhere in there is sort of a point on a spectrum that's our future. And where in that process is the ball going to settle, and how much regulatory crackback is there going to be? And then I think that's what differentiates it from the 1990s or the 1920s. Everything else looks to line up really well and really similar, so that there's the possibility of a stock market mania. But in this case, because of the unique functionality of the technology, it's possible that there could be a kind of gap in that narrative, which is really about the fact that there's got to be more of a regulatory narrative that comes into the picture, because otherwise the whole thing kind of falls apart. It's the paradigm, right? So it's an economic paradigm question. It's sort of a superstructure in terms of the time frame narrative. But otherwise, it's the 1920s, it's the 1990s, it's right now. You have a bunch of people who are too pessimistic. You have breakout technologies. The chart patterns line up, everything lines up, that this is kind of the period where we start to see that kind of interaction. You've had a lot of people who have a lot of money that's been on the sidelines for a long time that could come into this market and really take things considerably further. And on a shorter time frame perspective, if the interest rate picture over the next 3 to 6 months doesn't add up to what it looks like the projections suggest, you're going to have some kind of correction in the process. But I would view that as aside from this regulatory narrative, I would view that as a really great opportunity. If we see that kind of situation, we see all these patterns spill, I think it's just going to be another handle in the cup with handle pattern before we start to see some more speculative flavor come into the market.
All right, that's good insight, Brett. Just a quick heads up on the market. We are at session highs here. We're at 48.12. So bulls have been able to hold on to this. S&P now up 0.85% on the session. A strong day for equities. A nice bounce back. All right, Brett. With that, I will let you get going on your side. I know you got a bust pipe to take care of over there. So get to that before you have an ice rink in your place with the temps there. Everybody else will be shutting down here. I'll be jumping back on in about 10 minutes and covering stocks that are going to be reporting at the close. JB Hunt, that's certainly going to be one that we're going to want to keep an eye out on. PPG Industries as well, leading the way. Then a couple more regional banks with the Bank of Ozark and FNB Corp. So the relatively slow after hours, but JB Hunt's going to be interesting. But hey, Brett, thanks so much for jumping on here, giving us your thoughts, and always very much appreciated.
As always, Gavin, it's my pleasure.
All right. We'll talk to everybody in a couple minutes.